All right, good morning, everyone. Thank you for joining us today. We're going to look beyond all that hype that's been going on, especially around Bitcoin since the re-election of Donald Trump. Obviously, he's being called the first crypto president stepping into the White House again. And I have a great panel for you ready. So why don't we start with a quick round of introductions. I go first. My name is Jonas. I represent 1IO, oversee all communications there. I'm a novelist as well, and I've written the first Web3 thriller, which is coming out on Friday. And we're gonna look at a couple of things that are going on in the space and really trying to deep dive into how we can move from hype to utility. So why don't you start, Mitch?
Yeah, my name is Mitch Diarmando. I'm with Steelwave Digital. Really what we are is Steelwave is a massive real estate development group, so I'm kind of bringing them into the future here. We're trying to bring our portfolio into the tokenization space. We're doing some strategic acquisition ideas, and we're pretty excited to be on the front lines of this new push. So.
Great.
Hi, Jay Jacobs with BlackRock. We are the world's largest asset manager, and through our iShares lineup of ETFs are really focused on enhancing access and improving financial outcomes for investors around the world. This year we brought out our first two digital asset ETPs, IBIT, which is the Bitcoin ETP, and ETHA, which is Ethereum. IBIT has gone on to be the fastest growing exchange-traded product of all time, crossing $40 billion in 10 months.
Hi, I'm Alan Konevsky. I'm with T0. T0 is one of the earliest innovators with the use of blockchain in the capital markets. Our focus is to support this technology in various phases of primary and secondary liquidity in private markets, as well as other use cases. We're supported by a number of industry-leading participants, including the Intercontinental Exchange, and it's terrific to be here. Hopefully more utility than hype.
And Ian Graham, I'm at Lockton. Lockton is the world's largest privately held insurance broker. I lead our digital asset blockchain team here in the US, so we help clients understand all different types of insurance and exposures that they may have. And a big part of our job too is on educating insurance markets. There's a lot of misconceptions out there, so a big piece is making sure they are providing the capacity that our clients need.
Great, we're going to dive into that later as well. So Jay, the SEC previously approved 11 spot Bitcoin ETFs in January, followed by spot Ether ETFs in May. And since their introduction, spot Bitcoin ETFs have generated significant trading volumes exceeding 500 billion. And BlackRock's IBIT commands a dominant market share, accounting for nearly 2/3 of the activity going on there. And yesterday, the OCC announced its readiness to manage the clearance and settlement of options on spot Bitcoin exchange-traded funds. So with major players like BlackRock on the field, how do you think the markets around crypto are going to evolve in the future? What is there to come?
Sure. So, in a lot of ways, what the exchange-traded products have done, like IBIT, is just make Bitcoin more accessible to more investors around the world. For many, they had already been getting exposure to Bitcoin, buying it directly through exchanges, maybe buying futures, maybe buying stocks that are kind of tracking stocks for Bitcoin. But in many ways, those can be impure or less than desirable ways of getting exposure to Bitcoin. An exchange-traded product you can buy in a brokerage account. It can sit alongside your stocks and bonds and really just provides easy access for buying any exposure, whether it's the S&P 500 or a basket of bonds or now Bitcoin or Ethereum. And so this access vehicle has become very popular because it's simple, it's easy, and it's delivering people the exposure they want in a tax-efficient and high-quality wrapper. What I think is changing beyond just that, maybe that person that already owned Bitcoin that now is buying it through IBIT, is there's a whole world within traditional finance of people who maybe previously couldn't or didn't have the capability of getting exposure to digital assets prior to these products existing. You could think about kind of traditional asset owners, pension funds, endowments. You could think about financial advisors across the United States. For many of them, they just didn't have an easy way of getting exposure to these assets. Now they do. And so what that means for us at BlackRock is really starting an educational journey for a lot of these professional investors who haven't considered these assets before on simple building block items. What is Bitcoin? How does it fit in a portfolio? How does it compare to Ethereum? What does it mean to hold Bitcoin alongside stocks and bonds? So I think from our perspective, it's really we've now kind of provided that access through iBit. It's about the educational journey of bringing traditional finance more into this world and more up to speed with how these assets work.
Great, thank you. So one of the things you said there is making Bitcoin more accessible, or the crypto space as a whole has a problem, in my opinion, with communications. Right, it's very, very, very complicated for traditional investors or for the common people out there trying to put their money into the space. So a question for all of you, whoever likes it, from your perspectives, what apart from communications, are the biggest challenges, whether regulatory, technological, or cultural, that are slowing at the moment the adoption of tokenization and the access to the market in markets like the US compared to regions like Dubai or Singapore?
I mean, for the real estate side, it's all regulation. We launched a fund probably about 12 months ago, and we wanted to put it in the US, but we just couldn't. So we ended up putting it in Bermuda. It's a traditional LP vehicle, but we give our investors the option to tokenize. So you're not really saying, hey, I want you to go tokenize your position. It's like, hey, we're giving you this option to get some secondary liquidity. And I think that's what's going to kind of warm up your institutional investors to this space. But again, they're not going to do it if there's no regulatory clarity. So as guardrails kind of come up, I think you're going to see a big adoption of that into the space.
Yeah, look, I think people love to blame regulation and politics, and to some extent, it's an external factor, and it's an easy windmill to focus on, and a lot of it is true. And we might be entering a phase now that's going to resemble, worst case, benign neglect compared to the last 4 years, where enforcement is going to step way down except for true bad actor type situations. And you're going to see the market, at a minimum, continue to operate the way it has been, minus the pervasive threat of regulation by enforcement. You might see some rulemaking at the SEC and other agencies, particularly as they rediscover that there's a lot they can do with exemptive authority that doesn't require new legislation. You might also see some of the proposals that we've seen talked about on the Hill. And remember, crypto lobby had a lot to do with who is going to be there and who isn't going to be there when new Congress is seated and the new president is sworn in. You might see some of these ideas translate into legislation, whether it's going to be revolutionary legislation or more piecemeal, impacting stable coins, for example. That's a separate conversation. But worst case, you're going to have benign neglect, and the market can continue to develop in that environment pretty well. I think one of the bigger challenges, and it's not one that we can point a finger at somebody else for, is product innovation. And they're two separate questions, right? We've talked about new products that might make native digital assets more accessible to investing segments that before that haven't felt comfortable or weren't able to touch them from an infrastructure perspective. So you have ETF wrappers that make native digital assets available, and that's a terrific thing. There's a separate question about using blockchain technology. That's both the ledger and, importantly, smart contract automation to build assets. And that's the trick. That's the next challenge. And not to use them to build assets for their own sake. I mean, you always think of Steve Jobs, right? Consumers don't really care what the underlying rails are, what the guts are. They want features that make their lives easier. And so how do you build new financial products using this technology, the ledger piece of it, and smart contract automation in the way that is appealing to retail and institutions, and communicate it effectively, because we do have a lot of baggage, rightly or wrongly, that we have to deal with.
Absolutely. Yeah, go ahead.
Yeah, just real quick. I would agree with, obviously, the regulatory confusion and hostility in some instances. You mentioned communication as well. We just see it from our slice of connecting companies with insurance companies, but I imagine it's a problem with connecting digital asset companies, fintech companies with all sorts of capital markets and more traditional established players. I think investing the time and really making sure those counterparties really understand what you're doing, what you're not doing, that message is sort of positioned in the right way. It takes a lot of time, it takes a lot of investment, but that's where we've seen true partnerships between the more traditional insurance world with our clients really work. So I would echo.
Great. Yeah, let's dive into the insurance side of things for a second. So how is the insurance industry adapting to support tokenization, and what roles does insurance play in fostering trust and enabling growth in this space?
Yeah, so look, I mean, when I think about utility, I think about continued adoption and how in our role we can help the industry continue to evolve, grow, prosper, and just foster adoption. Look, it's a slow-moving industry, and it's taken some time, but the market, the insurance market, to their credit, has really come a long way, and there are a lot of very creative, forward-thinking insurance companies out there and brokers like our team that are really trying to provide meaningful solutions, not off the shelf. This fits for a bank, so it's going to fit for you, but really, again, trying to dive into what is the actual liability, what are you actually doing, what are you not doing, why are things set up that way, and trying to drive meaningful solutions for the industry.
Great. So we see a lot of industries gathering in the digital asset space. I'd like to dive into the real estate part. Mitch, you said tokenization is a game changer in asset ownership, and it's about modernizing investment strategy for a new era, and real estate has been seen as a potential candidate for tokenization, but is also known for being traditional and slow as an industry. So what lessons can we draw from this sector's journey into tokenization, and what other asset classes might be next?
Yeah, I mean, I'm probably the youngest in my company by about 20 years. And when I started chatting with people about this, they were like, what are you talking about? But what we started to see is, we see blockchain as a game changer for asset ownership and transference. And I'm not saying, we're going to go tokenize a $100 million building tomorrow, but it's kind of like the CMBS days where you can slice up your capital stack and you start selling out LP slices of that and call it new forms of debt, new forms of, raising vehicles. But it opened up a lot of doors. And especially for groups like us, we have a lot of core assets, and we don't really want to sell our core assets. So if we can tokenize out, give cash flows, but still keep those assets on our balance sheet, it's a big plus for us. And obviously, the real estate space right now, if you're an owner, it's probably not the best time. If you're a buyer, pretty good time. In San Francisco, we're seeing what was $1,400 a square foot trade $200 a square foot right now. You're in a really good buying opportunity to really seed, some killer assets into this space. That's what we're trying to push right now.
I'll make an observation that real estate and a lot of other real-world assets probably fall in that bucket as well. And I have twin vectors on blockchain technology. One is using the technology itself, whether it's a distributed ledger or whether it's smart contract automation, to introduce efficiencies into the asset itself. In the real estate space in particular, you're talking about title transfers, for example. We used to have a sister company called Medici Land Governance that was innovating outside of the US with tokenizing real estate titles. So it's a really balkanized system. It's opaque, it's expensive, and putting real estate on blockchain makes a lot of sense. Title insurance costs go way down, other efficiencies are introduced. The other vector on it is to use blockchain technology to innovate with securitization of these assets. That's the one thing that's important to keep in mind, is that tokenization in and of itself, in the United States at least, given how the law is, typically means also securitization for most of these assets. And so you are then innovating with use of distributed ledgers and smart contracts to support how these securities are structured and sold. Other countries, tokenization might mean something that actually provides you a less onerous way to securitize and fractionalize and raise capital against your assets. In the U.S., it's one and the same, and so those twin paths use technology to improve the asset itself and use technology to improve fractionalization and securitization. Twin and separate challenges, and sometimes they're commingled, but they really pose very, very separate and vast opportunities in the U.S. or abroad.
Anybody want to comment on that? All right, Mitch?
I mean, for us, we're seeing this as access to new capital, right? We've been dealing in your traditional players, big institutions, pension funds, slow to move. This is a new form of permanent capital to us, where if we can go, all right, let's go, buy Westfield Mall in San Francisco and make it into Chelsea Market, right? We don't have to go find a JV, go handhold everyone to do that. We could just bring it to open market and raise it. Now, I don't think that's going to happen, 12, 18, 24 months from now, but I do think that's the future of this space. And what that does is it allows international money to come into these private investments that they previously would not have been able to do, at least not at the minimums that, they can wrap their heads around.
I think kind of the broader trend here that's really interesting is, as you were just saying with tokenization, it's access to new capital. In some ways, tokenization can be seen as taking traditional assets and making it available to kind of assets that are more native to decentralized finance. In the ETF world, we took a decentralized finance asset like Bitcoin and Ethereum and brought it to traditional finance. So what you're seeing is kind of two directions of travel here, where both traditional assets and digital assets are looking for new pools of investors and really looking to diversify their asset base. So I just think it's kind of an interesting contrast to see these, kind of traditional to DeFi and DeFi to traditional.
And I'll just add, I think as we're all talking about sort of continued adoption, one of the major conversation points when we're talking with firms involved in tokenization, asset managers, we go into some very deep brainstorming discussions around, okay, what are the actual potential losses here? And this has helped get some of the insurance companies on board, actually, because the assets underlying tokens are usually very secure. I mean, we'll take real estate out of it for a second, but things like gold or T-bills or US dollars, I mean, those aren't really at risk. And so that's helped get some insurers, again, a true understanding of what is the actual loss that they would be looking at, or what's the client actually trying to insure. I mean, it's usually any sort of liability that an asset manager might have to their customers if customers weren't able to access the tokens, missed out on a trade. So it's almost a lost income liability from a tech failure, or if your platform is down. I bring this up just because I think it's been, it's been another conversation point of really getting at what the true risk is, what the true loss is, and that's helped, again, bring some more traditional insurers into the space.
Great, thank you. Mitch, you said players like BlackRock are beginning to recognize the potential of tokenization. We already touched on that, and signaling the dawn of what could easily become a $1 trillion market by 2030. Now, what do you think, apart from what we talked about already, needs to be done to really realize this?
I mean, I think we're still in the beginning stages of this, right? What I tell people coming into our fund, I go, look, the way it's traditionally set up, it's almost like having a TV with like 3 channels. What this does is it brings streaming to your TV. It's like it opens up so many different avenues to get it. And I think over time, you're going to see a lot of these archaic, LP ownership certificates or, syndicates morph into this and be brought onto chain just for efficiency. I mean, you could probably speak to that pretty heavily with what you got going on.
Yeah, great. My take on coming back to the from hype to utility thing, it's not just about money and finance, but it's also about the tech underneath as well. And Alan, you said, like Steve Jobs said, when the technology becomes invisible, the people really want to use it. I don't need to know how my phone works to call my mom, right? So we talk about the shift from hype to utility, and crypto and digital assets can be a driver for digitalization. Also, we see it a lot in Europe, where the adoption of cryptocurrency leads to a broader digitalization in small and medium enterprises, especially as well. How is it in the U.S.? Would you say this is a true statement for the U.S. as well?
Yeah, look, I think it's a very fair point that crypto is a gateway drug to blockchain. That's true, and that's the good thing about it is, and it's sort of the paradox as well. On the one hand, it elevates the conversation about the utility of natively digital databases with natively digital assets that are self-regulated in an environment that is transparent, accessible, inclusive, cheaper, and faster. Again, some of the technology hasn't caught up to the maximalist vision yet, but that's the idea, and it elevated the conversation around that topic, and how in money, for example, we haven't really created public infrastructure for money since coinage and paper money was invented thousands of years ago, in coinage case, and paper money goes back, kind of to China, 1200s or so. You read kind of accounts of, Ibn Battuta and others who went back, so almost 1,000 years ago. That's how long public infrastructure for money has been around. So this is an opportunity for us to create different infrastructure layer, public infrastructure layer, that then lets people interact with value ecosystems the same way that intranet has permitted people to interact with data and voice in a very direct, or far less intermediated way. And again, that's more inclusive, faster, cheaper, more transparent. The downside is, of course, that crypto, gateway drug for this, that's good. It's also brought with it a lot of baggage, rightly or wrongly, around some of the social and political topics that we worry about with respect to bad actors, money laundering, financial speculation, suitability. And so the trick is to box in the latter and to focus on the former, whether the former is being used to improve underlying assets, real estate, cars, art, revenues associated with entertainment products or athletes, or whether it's being used to innovate in the financial ecosystem to improve the security settlement cycle, to reduce the number of intermediaries, to take out other frictions. That's the idea. I think we're probably still stuck in the United States on boxing in the latter and kind of dealing with the baggage. And while there are a number of innovative projects that look to use technology to improve back office in a number of industries, security is one of them, real estate another, it's still early days on that, which is not a bad thing because the potential is infinite. I mean, you think about other infrastructure improvement projects in other industries, whether it's electronic trading, whether it's dematerialization of securities, whether it's similar processes that went on in real estate and other industries. And so that, it's a technology revolution, and that doesn't get talked enough about. People talk about speculative assets for better or for worse. People don't talk about that it's a technology revolution first, that, yes, requires native digital assets in order for the technology to run, but it's a technology revolution first.
Anybody want to add on that?
Yeah, I'll just add, I've talked mostly about sort of the off-chain insurance. Look, the insurance industry, like asset management or real estate, is ripe for efficiency process change as well. So this is early stages also, but there's a lot of paper, a lot of emails, a lot of documents that are all shared throughout the insurance process. And there's some very innovative things happening, I think, around policy issuance, quote issuance. I know this isn't the most thrilling thing to think about, but there is, there's a lot that blockchain technology can do from the process side. And then the most forward-looking insurers, there is actually on-chain insurance that are governed by smart contracts. So instead of, if you've ever had to work through, a claims process, whether it's business or with your auto or home insurance, things that promise the immediate payout if this event happens, all governed by smart contracts. Again, that's a very small piece of the market at this point, but I think there's major potential to revolutionize that, just like it's revolutionized other industries as well.
Great, thank you. Jay, the sole fact that BlackRock has moved into the space has established a lot of trust because it's actually very conservative company, right? So could you give us an outlook on what's to come? There's going to be a lot of new investors coming into the space. What's to come for 2025 and the following years?
Well, so I'd actually take a little bit of a step back and share a little bit of our journey with how we got comfortable with Bitcoin and Ethereum. So this is really a journey that we've been on for 5 or 6 years at this point. And what's changed over that time is several things. One is really there's just been a tremendous amount of client demand. We heard this from clients around the world different types of clients, institutional clients, intermediary clients, that were asking for a better way to get exposure to digital assets like Bitcoin and Ethereum. So we certainly knew client demand was there. The second thing is we saw a lot of infrastructure improvement in digital assets over the last several years. So this is something that, as you see the $100 billion of venture capital that went into blockchain technologies over the last several years, has really professionalized the infrastructure. You've seen a lot of people and human capital move from TradFi into the DeFi world, bringing that expertise into upgrading the infrastructure. We've had progress in the regulatory front, such as the approvals for Bitcoin ETPs, making a little bit more regulatory clarity. And on top of that, from our perspective, we've really built out full integration with our partners like Coinbase, their technology into our technology stack. So this was a multi-year journey to get to this point, to get this level of comfort for Bitcoin and Ethereum products. I think as we look forward, there's still a lot of wood to chop with just Bitcoin and Ethereum from our perspective. So many investors are still just starting their journey in digital assets today. I know people are excited to jump ahead and say, what's next, what's next? For a lot of traditional finance, what's next is still Bitcoin. And that's what gets me excited about my work, my team's work, and more broadly across BlackRock, is just how do we educate people on where Bitcoin fits in a portfolio? What's its unique characteristics? Why is this potentially beneficial for someone who doesn't have a diversifying asset that could behave well in an environment where you have persistent inflation or you have growing geopolitical fragmentation? So again, education is what's next, more than what I would consider kind of rapid product innovation.
Great, thank you. So for the closing remarks, I'd like to do the same question again. What's next for the tokenization space, real quick? Ian, starting with you.
Yes, I think just back to what I was hitting on there. I do think down the road, things like on-chain smart contract covered insurance, that's probably years away. But from my perspective, it's continued pushing an expansion of real, meaningful insurance capacity that are helping our clients continue to focus on the things they need to focus on building, where they actually know they have that balance sheet protection. So just continued expansion of the market.
Great, thank you. Alan.
Yeah, I think you're going to see three vectors. One is you're going to see continued use of traditional financial technology to make native digital assets, Bitcoin and Ether and others, more accessible to the investing ecosystem. When you think about the underallocation into digital assets globally among financial advisors and high net worth portfolios and others, you're going to see more penetration to that using traditional financial tools, whether it's ETF technology or something else. That's number one. Number two, you're going to see continued improvements in the securities industry using blockchain technology, the ledger, and a smart contract part of it to introduce greater efficiencies. We're going to dream a little smaller. Public equities markets are not going to be tokenized overnight, but we're going to dream a little smaller and innovate in private markets and public markets. And then number three, you're going to see the same thing in just other asset classes and other industries, whether it's real estate, other real world assets, where blockchain technology and smart contract automation in particular is going to take out some of the legacy processes and technologies.
Mitch, real quick.
I think it's going to be a new asset class coming in, right? These institutional scalable investment opportunities coming into the space where institutions want to put money towards it, right? An institution, it's hard for them to put 20 million in. They want to be putting 200, 250, a billion. Scale is the biggest thing. So I think as you start to get more institutional grade assets coming into the market, you're going to start to see more institutional grade investments coming alongside.
All right, great, thank you. I'd like to thank, on behalf of the whole panel, Benzinga and especially Renato for having us. Thank you and have a good day.